Audio Jungle. Hello everyone. Today, first I will explain about definition. Firstly, for definition for financial liability, according paragraph 11 of NFRS 132, provide definition which is generalized, summarized as a contractual obligation for entity to leverage, cash or exchange financial asset. Next, for definition of financial equity, according paragraph 11 of MFRS 132 standard, as the contract that result in a residue in the asset of the entity after deducting all of its liability. Next, I will explain about characteristic of financial liability. According paragraph 4.2.1 of the MFRS 9 standard, financial liability is generally classified as first, fair value at profit or loss, secondly, amortized cost. So firstly, I will explain first about fair value at profit or loss. Initial measure at fair value and the subsequent measurement which the change in value result in profit and loss is recorded in income statement. So the entity might elect for the bond to be classified as a fair value profit loss to eliminate the accounting mismatch. Then match the gain or loss arising from the change in the fair value of derivative. Early amortized cost. Initial measure at fair value and the subsequent measurement at an amortized cost. According MFRS 9 that all financial liability is to be classified as amortized cost. A. If the financial liability is derivative. B. If a transfer of financial asset do not qualify for a recognition. C. If the financial liability constitute a financial guarantee contract. D. Loan provided at a below market interest rates. Next, characteristic of financial equity. According paragraph 16 of MFRS, discuss the condition that need to be classified as equity instrument. Instrument must not constitute a contract that requires the issuing company to leverage cash or other financial asset to another entity or exchange financial asset or financial liability that will result in an unfavorable condition to the issue. We need to be observed and fulfilled before equity instrument can be classified.
Next, what is the difference between liabilities and equity? Liabilities and equity play significant roles in a company's balance sheet. Liabilities and equity balance are both presented on the credit side of the balance sheet from an accounting perspective. However, the cost of liabilities such as interest expense on borrowing is subtracted as a financing cost from the income statement. Distribution to owners such as dividend are not considered expenses and are deducted directly from equity. The relationship between liabilities, asset, and equity is clearly defined by the accounting equation. The difference between a company's asset and liability values is referred to as equity or capital. Both equity and loans can be used to finance an investment or project. Liabilities, however, are distinct from equity because they represent an obligation that the company must fulfill. It is the amount that are owed by the firm. In contrast, equity is the sum of money invested in the company, which may come from owner contribution or shareholders' investment in the company stock. It is a form of ownership in the firm, and equity holders are known as the owners of the firm and its asset. Another distinguishing features between liabilities and equity is that the return on equity such as dividend and capital gains, is primarily based on the business performance. In comparison, the interest rate of liabilities is usually a fixed and predefined percentage that does not vary with the future business performance.
Next, I will present about the problem arise from the article. The first problem of environmental liabilities that is negatively related to the use of debt is reduced taxable income and in turn lower firms' marginal tax rate. Environmental liabilities are a significant source of tax savings, and companies with higher environmental liabilities should, on average, have lower tax incentives for debt financing. This is supported by D'Angelo and Maximus. Second problem is environmental liabilities also increase firms' business risk. Firms with large environmental liabilities are unavoidably exposed to additionally uncertainty due to more strict environmental rules, which might result from fluctuating market demand led by their environmental reputation. The chance of financial distress and bankruptcy among business is increased by the higher risks and uncertainties caused by environmental liabilities. The last one is supply side factors. Supply side factors is negatively related to the use of debt. According to Chava, lenders are hesitant to finance environmentally responsible resources and therefore charge borrowers with stronger environmental concerns much higher interest rates. The researcher predicts that a firm's environmental liabilities will limit lenders' willingness to extend credit, particularly to large and well-known banks.
The approaches that might be used by the standard setter for this issue is FASB requires that environmental costs must be reasonably estimable in order to be accrued. The quantification of the estimated liability may be a specific amount or range of amounts. If one amount within the range is better estimate than any other amount within the range, guidance requires recognition of that best estimate. If no amount within the range is deemed the best estimate, the minimum amount in the range is recognized. Estimated costs should be based on the clean-up plan, assuming current technology and current costs. FAS 5 also only addresses losses or asset impairments that occurred as of the end of the accounting period and typically does not take future commitments such as changing the production process to prevent or reduce pollution into account. Firms may also choose not to accrue environmental liabilities if they can show that those liabilities fall under the low recognition threshold set forth in the FAS 5.
From Roberts, 1995, this book consists of modifying production processes to prevent or reduce pollution. If business can show that their environmental liabilities do not reach the low recognition threshold set by Financial Accounting Standard 5, they are also permitted to avoid accruing those liabilities. The second book is from Lee and Fabrici, 2009, showed that Financial Accounting Standard 5 result in disparate and inconsistent accounting practice and widespread underreporting of environmental liabilities. In addition, FK and Upper 2021 examined the 947 Corporation's environmental findings from 1997. They discovered that 30% of business declared environmental accruals and 48% of businesses could disclose ongoing environmental measures initiatives.
For the second approach that I would like to present is that environmental liabilities should be accounted for using the fair value cost estimation methodology, which is incurred if a reasonable estimate of fair value can be made. And the FAS 143, which was issued in 2003 by FASB to directly address the accounting of environmental liabilities, stated that this method should be considered multiple cost estimate scenarios and probabilities. A liability for those environmental may be incurred over more than one reporting period if the event that creates the obligation occur over more than one period. Any incremental liability incurred in a subsequent reporting period shall be considered to be an additional layer of the original liability. Each layer shall be initially measured at fair value. Other than that, upon initial recognition for the environmental obligation, the involved firms shall capitalize an asset retirement cost by increasing the carrying amount of the related long-lived asset by the same amount as the liability. Instead of using the minimum allowed under FAS 5, an expected present value technique will usually be the only appropriate technique with which to estimate the fair value of a liability for an asset retirement obligation.
Next approach is to take on debt increase with the company's marginal tax rate because of the tax deductibility of interest expense. Thus, include the corporate marginal tax rate (MTR) and include the debt resting in the capital variable. Then control for analysis coverage by including the maximum number of analyses that make annual earning sources.
To conclude the report that my group have already presented, I would like to finish their point that the topic that have been issued is that relatively few previous studies examine the impact of corporate environmental liability on firms' financing decisions. In my opinion, although environmental liabilities have stagnated and become an increasingly important issue for investors and corporate managers, there are still have a few solutions and approaches that can be taken as an action to reduce high environmental liability. It is my view that firms with high environmental liability are such a serious matter that really need attention and to be concerned. It is because firms with high environmental liability maintain low leverage ratio and have a higher fraction of bank debt in total debt. This in turn can affect the firm's positioning and their stability themselves in the relevant market. In addition, many results are robust to a variety of tests on variable definitions, endogeneity issue, and alternative measure of environmental liabilities. In sum, our analysis revealed that a firm's environmental performance is an important determinant of its capital structure. We can't deny that it can be financially rewarding for firms to be environmentally responsible.